It's a logical consequence of decisions that have already been made. I've been studying markets and economic systems for over 40 years, through multiple cycles, across different countries and currencies. I've seen what happens when governments face the choice between allowing deflationary pain or inflating their way through problems. They always choose the same path. Always. When you understand incentives, you understand behavior. And right now, the incentives for every major institution, central banks, governments, pension funds, insurance companies, all point in the same direction. Consider these three data points carefully. The Federal Reserve's balance sheet, even after quantitative tightening, remains at $7.4 trillion, more than 7 times its pre-2008 level. Total U.S. debt has reached $38 trillion, with annual interest payments now exceeding $1.1 trillion, more than we spend on defense. And critically, Social Security and Medicare face a combined unfunded liability of approximately $78 trillion over the next 30 years. These aren't abstract numbers, they're obligations that must be met, and there are only 3 ways to meet them: growth we don't have, austerity no politician will accept, or inflation that reduces the real value of these debts. Here's what's actually happening with real estate prices and why it matters more than most people realize. Housing prices aren't staying elevated despite economic fundamentals. They're staying elevated because of economic fundamentals. The fundamental that matters is this: there's too much currency chasing too few hard assets. Real estate is one of the primary ways wealth escapes the devaluation of currency. When people look at an $800,000 home that sold for $400,000 in 2012, they think prices doubled. That's not quite accurate. The house is the same house. What changed is the measuring stick. The dollar bought more house in 2012 than it does today. Now, I want you to think about this like a dam holding back water. For the past 18 months, the Federal Reserve has tried to drain water from the reservoir by raising interest rates to their highest level in over 2 decades. In a normal system, this would cause the dam to lower, prices to fall, affordability to improve. But the dam isn't lowering. Why? Because while the Fed was draining water from one side through higher rates, the federal government was pumping in even more water from the other side through massive deficit spending of nearly $2 trillion annually. The reservoir level barely budged. Actually, in many markets, it rose. There are 4 specific pressures building right now that real estate prices are revealing. First, currency debasement is accelerating. M2 money supply, even after recent tightening, is still 38% higher than pre-pandemic levels. Second, demographic demand remains strong as millennials, the largest generational cohort, enter peak home buying years with 73 million people competing for limited inventory. Third, institutional investors have fundamentally altered the market structure, with single-family rental companies and private equity funds now owning over 800,000 homes, treating residential real estate as an inflation hedge rather than just shelter. Fourth, the construction of new housing has consistently lagged household formation by approximately 400,000 units annually for the past decade, creating a structural shortage that high interest rates alone cannot solve. When you combine scarce supply with abundant currency, prices don't fall. They find a new equilibrium at a higher nominal level. History is an excellent teacher, and we've seen this pattern before. In 1971, President Nixon closed the gold window, severing the dollar's last link to tangible value. Between 1971 and 1980, median home prices in the United States increased by 177%, while the dollar lost approximately 60% of its purchasing power against gold. People who held cash saw their savings eroded. People who held real estate saw the nominal value of their homes surge, not because housing became more valuable in real terms, but because the measuring stick shrank. The 1970s had rising interest rates, economic stagnation, and persistent inflation, stagflation. Prime rates reached 21.5% in 1980. Yet housing remained one of the best performing asset classes precisely because it represented escape from currency debasement. Families who bought homes in 1971 with 30-year fixed mortgages were paying back their loans decades later with dollars worth a fraction of their original value. Their debt was inflated away. After 2008, central banks chose inflation over deflation. The Federal Reserve expanded its balance sheet from $870 billion to $4.5 trillion by 2015. Housing prices have climbed 147% from the 2012 bottom. Not because housing became more productive, but because the quantity of currency increased dramatically, while the quantity of desirable housing did not. The pattern repeats because the incentives are always the same. To understand what real estate prices are revealing about 2026, you need to understand three fundamental principles that govern how currency systems behave when they reach certain mathematical thresholds. The first principle is that debt to GDP ratios above 100% in developed economies create what I call the inflation imperative. When a nation's debt exceeds its annual economic output, the mathematics of repayment become impossible through conventional means. You cannot grow your way out because the debt grows faster than the economy. You cannot tax your way out because confiscatory taxation destroys the productive base. The only path is to reduce the real value of the debt through currency debasement. The United States crossed 100% debt to GDP in 2012. We're now at 124% and climbing. Japan is at 264%. Europe averages 95%. These aren't temporary emergency levels, they're permanent structural features of modern economies. Think of it this way. Imagine a restaurant that borrowed $100,000 when it earned $100,000 in annual revenue. That's manageable. 1 year of revenue could theoretically pay the debt. Now imagine that restaurant borrowed $100,000 but only earns $80,000 in annual revenue, and that revenue is growing at just 2% per year, while the debt grows at 6% because of interest and new borrowing. The gap widens every year. The restaurant can never catch up through growth alone. It has three options: go bankrupt, renegotiate the debt's terms, or convince creditors to accept repayment in a currency that's worth less than when they lent it. Governments always choose option 3. They pay back $100 debts with $80 bills, claiming they're still $100 bills. The second principle is what I call asset price inflation versus consumer price inflation. Central banks and governments prefer asset price inflation because it's politically tolerable and economically stimulative in the short term. When stock prices rise, when real estate appreciates, when bond portfolios gain value, people feel wealthier. They spend more. They borrow more against inflated asset values. Politicians take credit for rising 401k balances. But this creates a trap. Once you inflate asset prices substantially above historical norms relative to incomes, you cannot allow them to deflate without causing catastrophic wealth destruction that would destabilize the entire financial system. Banks hold real estate as collateral. Pension funds depend on asset returns to meet obligations. Insurance companies invest premiums in bonds and stocks. The whole structure is now dependent on elevated asset prices. This is why real estate prices aren't falling despite higher interest rates. The system cannot allow them to fall. A 30% correction in housing prices would render millions of recent mortgages underwater, would devastate bank balance sheets, would destroy household wealth that supports consumer spending, would trigger a deflationary spiral that would make the debt burden even more crushing in real terms. So the Federal Reserve faces a choice: allow deflation and depression, or ensure enough currency creation and economic support that asset prices stabilize at elevated levels, even if it means higher structural inflation in consumer goods over time. They're choosing the latter. They must choose the latter. The third principle is the currency alternative hierarchy. In times of monetary instability, wealth flows into assets in a specific order based on their ability to preserve purchasing power over extended periods. First level, currency and bonds. These lose value in inflationary environments. Second level, stocks of productive companies. These maintain some value but are volatile and depend on economic growth rates. Third level, hard assets with intrinsic utility. Real estate, commodities, precious metals, productive land. Fourth level, inflation-indexed instruments and foreign hard assets for additional protection. When people lose faith in the first level, they move to the second. When they lose faith in the second, they move to the third level. Right now, we're witnessing the early stages of rotation from level 1 and 2 into level 3. Real estate prices are elevated because smart money, institutional money, and increasingly middle-class money clearly understands that holding currency or long-term bonds in a high-debt, high-deficit environment is a guaranteed loss of purchasing power. Let me tell you a story about two families during 2008 to 2012. The Johnson family had $400,000 in savings in 2009. Tom was 52, a senior engineer. They watched housing prices fall 35% in Phoenix. Everyone said prices would fall further, So they kept their savings in CDs and bonds earning 2% annually, feeling smart avoiding the falling knife. The Martinez family had the same $400,000. Carlos, also 52 and an engineer, had lived through inflation in Mexico. In 2010, despite warnings, Carlos bought two properties, a $300,000 primary residence with $150,000 down at 5.2% fixed, and a $200,000 rental with $100,000 down at 5.5% fixed. He kept $150,000 for emergencies. People thought he was crazy. By 2020, the Johnsons' $400,000 had grown to $485,000 through conservative interest. But inflation had eroded purchasing power by 24%. In real terms, they'd lost ground. The Martinez family's primary residence was now worth $525,000, with $215,000 owed, $310,000 equity from their $150,000 investment. The rental was worth $360,000, with $145,000 owed, $215,000 equity from $100,000. The rental generated $198,000 in cash flow over 11 years. Their remaining savings grew to $182,000. Total, approximately $905,000, a 126% gain. Their fixed mortgage payments decreased in real terms while income grew. This isn't made up. It's the typical pattern. The difference wasn't intelligence or luck. It was understanding currency, debt, and inflation. Now let's translate this to what really matters, how this affects you. If you're 55 with $600,000 in retirement savings in a 60-40 stock bond allocation, understand what's coming. The bond portion, roughly $240,000, is a bet that currency maintains purchasing power and inflation stays low. But if inflation averages even 4% over the next decade, that $240,000 will have the purchasing power of approximately $162,000 in today's dollars. Consider an increasingly likely scenario. The federal government faces accelerating deficits as debt interest payments exceed defense spending. Social Security and Medicare costs rise. The Treasury issues more bonds, but foreign buyers are less interested. China's holdings fell from $1.3 trillion to under $800 billion. The Federal Reserve faces a choice: allow rates to rise to market levels which would crash the economy, or step back in as buyer of last resort, creating more currency, accepting higher inflation. They will choose the latter. History, incentives, and political reality all point in that direction. When they do, when currency creation accelerates again, real estate prices won't just remain elevated, they'll surge to levels that seem insane by today's standards. Not because housing becomes more valuable, but because the dollar becomes less valuable. A $600,000 home today might be a $900,000 home in 2026, not because it's a better house, but because it takes more debased dollars to purchase the same asset. This is what real estate prices are revealing right now. They're pricing in the future devaluation that mathematical inevitability demands. Here's the daily impact most people don't calculate. Let's say you spend $5,000 per month in retirement, $60,000 annually, on housing, food, healthcare, transportation, and basic lifestyle. If inflation averages just 5% annually, which is entirely plausible given the structural factors we've discussed, in 5 years that same lifestyle costs $7,660 per month, or $91,920 annually. Your fixed pension doesn't increase. Your bond interest doesn't increase. Your savings must cover the gap. A $600,000 portfolio generating 4% annually produces $24,000. But if that $24,000 buys what $16,000 bought 5 years earlier, you're forced to draw down principal faster than planned. The math that said your money would last 25 years now says it lasts 17 years. That's the hidden tax of currency debasement, and it's devastating for retirees on fixed incomes who thought they planned conservatively. Based on these principles, here are practical guidelines. If you're ages 35 to 55 with substantial savings, consider this allocation. 25% in productive real estate with fixed-rate financing or quality REITs. 25% in inflation-protected securities and commodities, including tips and precious metals. 30% in high-quality stocks with pricing power and low debt. 10% in international diversification. 10% in liquid reserves. Direct real estate ownership with fixed-rate financing is optimal. A $400,000 property with a $300,000 mortgage at 6.5% fixed becomes more affordable if inflation averages 4 to 5% over the next decade. Your payment is fixed while income grows. In 10 years, that payment represents a smaller percentage of income, while property value likely increased with inflation. Avoid long-term bonds unless inflation protected. A 10-year Treasury yielding 4.5% seems safe until 5% inflation destroys purchasing power. Avoid excessive cash beyond emergency reserves. Avoid variable rate debt. It adjusts upward while fixed rate debt becomes cheaper in real terms. Avoid waiting for prices to crash to 2012 levels. That crash requires deflation, and deflation requires accepting a depression no politician will tolerate. Take 12 to 18 months to reposition. The psychological shift is harder than the financial mechanics. Accept that advice from the 1990s. 60-40 stocks and bonds, hold cash, avoid debt, was calibrated for a different monetary environment with manageable debt levels and demographic support for growth. That environment no longer exists. Common pitfalls: moving too aggressively into illiquid assets without maintaining adequate reserves, trying to time the market perfectly, falling for exotic schemes you don't understand. If you can't explain the investment in 3 sentences, don't own it. Stick with simple, time-tested real assets: property people need, companies producing essential goods, commodities with enduring demand, precious metals that have preserved value for millennia. Nothing in this constitutes specific financial advice. Each person has different circumstances, different risk tolerances, different time horizons, and different needs. What works for a 45-year-old with 3 decades until retirement differs dramatically from what's appropriate for a 70-year-old living on a fixed income. Consult qualified financial professionals who understand your specific situation. But do consult professionals who understand the structural monetary environment we've entered, not those who are simply applying outdated playbooks from a different era. Here's what I want you to understand as we close. Real estate prices aren't high because of a bubble driven by speculation or irrational exuberance like we saw in 2005 and 2006. They're high because they're revealing a fundamental truth about the monetary system. There's too much currency relative to too few hard assets, and that imbalance is structural, not temporary. The choice is yours. But remember what institutions are doing, not what they're saying. Central banks globally have increased their gold reserves by over 1,100 tons annually for the past several years, the highest levels since the end of Bretton Woods in 1971. Why? Because central bankers understand currency risk better than anyone. Sovereign wealth funds are increasing allocations to real assets: infrastructure, real estate, farmland, resources. Corporate balance sheets at major companies like MicroStrategy, Tesla, and others are diversifying away from pure cash holdings into tangible assets and alternative stores of value. These institutions aren't making these moves because they expect currency stability. They're making them because they expect the opposite. The average American sees high real estate prices and thinks housing is expensive. The sophisticated investor sees high real estate prices and understands currency is cheap. There's a profound difference in those perspectives, and that difference determines financial outcomes over the next decade. That's why this channel exists, to help you observe what's actually happening beneath the surface noise, to understand the mechanisms that drive long-term outcomes, and to recognize signals before they become obvious to everyone. We observe signals before they become news. We study mechanisms rather than predictions. We focus on what's mathematically inevitable rather than what's emotionally comfortable. We help you see what most people miss until it's too late to act. If this analysis makes sense to you, if you can see how real estate prices are revealing deeper truths about the monetary system and what's coming in 2026 and beyond, then subscribe to this channel because we'll continue tracking these signals and translating them into understandable frameworks. The greatest transfer of wealth in history happens during periods of monetary transition. It flows from those who hold currency to those who hold assets, from those who trust nominal values to those who understand real values, from those who wait for conditions to improve to those who position themselves appropriately for the conditions that actually exist. You still have time to position yourself properly, but that window is narrowing as these truths become more obvious to the broader population. When real estate prices are revealing warnings about the fundamental structure of the monetary system, the wise listen and act accordingly. The question is, are you listening? And more importantly, are you acting?